There's no question that I think they've realized for a very long time that the pricing power, the West monopoly on metals pricing and settlement is something that they realize is a scam. Buyers in Asia aren't just looking for better pricing, they're seeking autonomy, they're seeking the ability to set the prices. This is a big deal that I think people are missing. And even when the BRICS grain exchange was developed last year, the guy that is behind it said, we in the global South produce and consume more grain than the West does, but we can't control the price. It's done on COMEX. But with the development of this grain exchange, that will change. I think you could say the same thing here about the move eastward. That's one of the scary things about the recklessness of the Western policies.
In a notable shift, raising serious concerns within the global financial system, pressure is mounting in the silver market as structural weaknesses become increasingly difficult to ignore. Andy Schectman, CEO of Miles Franklin Precious Metals, has emphasized the growing risks tied to the widespread use of silver leasing, where institutions borrow physical silver at near zero interest rates, sell it into the market for cash, and reinvest the proceeds elsewhere. While this mechanism offers cheap capital in a high-rate environment, the model begins to falter when the leased silver must be returned. According to Schectman, the core problem lies in the disconnect between paper contracts and physical inventory, a situation now creating visible stress across delivery obligations on exchanges like the COMEX. Schectman underscores that while the European Central Bank has voiced similar concerns regarding gold derivatives and counterparty risk, silver faces a more precarious situation. Unlike gold, silver lacks meaningful central bank support, leaving commercial banks particularly vulnerable to systemic shocks. The increasing number of participants standing for delivery each month signals a tightening supply that cannot be resolved solely through financial instruments. This shortfall could expose major financial institutions to serious losses, especially if a disorderly unwind of short positions were to occur. In his view, the continued suppression of silver prices in the face of such risks reflects not a functioning market, but a managed one that is approaching a critical inflection point. As global demand continues to shift eastward, with countries such as China, India, and members of the BRICS bloc seeking greater control over precious metals pricing, the long-standing dominance of Western exchanges is being directly challenged. New platforms in Asia, including initiatives in Singapore and Shanghai, aim to shift pricing power away from derivative-based benchmarks and toward physical markets. Schectman believes this evolution is not just a financial realignment, it reflects a broader shift in geopolitics and the economy. As confidence in Western market mechanisms erodes, he warns that the consequences for silver could be dramatic, a potential repricing event that fundamentally resets global perceptions of value, risk, and monetary stability. Now, we present the clips from Andy's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Well, and it's funny, and although they didn't speak directly to silver, although I would argue the silver is the exact same thing, in fact, on steroids, the ECB warned that gold is a threat to the global financial system. I'll just read something to you real quick. I'm sure you saw this. Last month, the ECB, the European Central Bank, warned of increasing counterparty risk in gold derivatives for the euro area. In the May edition of the Financial Stability Review, the ECB added that a significant share of these gold derivatives were over the counter and not centrally cleared, leaving actors exposed to counterparty risk. As you said, the LBMA is not an exchange, it's an over-the-counter system, I guess you call it. The big point to take on board is an official recognition that the stand for delivery obligations on COMEX are behind the crisis, and they continue. Since November, warehouse stock has shown 26,470,000 ounces have stood for delivery. Eurozone banks have swapped gold for paper, and the gold is disappearing in deliveries. Behind the ECB's public concern is a far deeper one. It is as close as we can get to official warning that the gold paper game is coming to a very nasty end, likely to drive gold measured in paper currencies far, far higher. And incidentally, the same problem exists in silver, but without the central bank participation, more of a commercial bank, which means it's an existential threat to some of these banks if the shit hits the fan. That's in essence what you are saying, correct? I think we're seeing a shift. Now you have Singapore getting into the game and opening up a market, a gold market. They want pricing authority to shift towards Asia. And I think that's what is happening, whether it be with the Shanghai Metals Exchange, now an exchange that's being developed in Singapore, the BRICS exchange. There's no question that I think they've realized for a very long time that the pricing power, the the West monopoly on metals pricing and settlement is something that they realize is a scam. And I think that buyers in Asia aren't just looking for better pricing; they're seeking autonomy. They're seeking the ability to set the prices. This is a big deal that I think people are missing. And even when the BRICS grain exchange was developed last year, the guy that is behind it said, we in the global South produce and consume more grain than the West does, but we can't control the price. It's done on COMEX. But with the development of this grain exchange, that will change. I think you could say the same thing here about the move eastward. That's one of the scary things about the recklessness of the Western policies that are allowing the exchanges to be drained and flowing eastward to countries like India, countries like China, countries like Saudi Arabia and Russia, and all of the countries that understand what silver represents, standing for delivery. And maybe by the grace of God, someone in the Trump administration said, look, we've got to do the same thing here. We're in big trouble. Hence all of the deliveries we're seeing. I don't know, Bix. I know you had me on your show, but I'll ask you. I mean, when do we see the price suppression end? What does it take for this to be overwhelmed, for these banks to realize that this isn't just stupid, it's an existential threat to their survival? Are we getting there? Are we almost there?
Silver is emerging as a strategic asset amid unprecedented physical demand, with recent delivery volumes on the COMEX highlighting a major divergence between institutional and retail behavior. As noted by Andy Schectman, May recorded the largest physical settlement in COMEX history, over $8.5 billion in gold and $2.7 billion in silver, underscoring a growing trend. The world's most informed financial entities are opting for physical possession rather than exposure through paper contracts. Schectman views this as a critical indicator that those closest to systemic information are repositioning into hard assets, while retail investors remain overly focused on conventional risk-on trades, such as equities. This bifurcation, combined with historically low premiums on metals, suggests the public is missing a crucial window of opportunity. Schectman also raises serious concerns about the structural integrity of the silver market, particularly the relationship between large short positions on COMEX and the supposed hedging mechanisms in London. With the LBMA reportedly transferring over 340 million ounces of silver daily, an amount that strains credibility, the legitimacy of these figures comes into question. Meanwhile, countries such as India are importing massive volumes of silver at suppressed prices, reinforcing the idea of quiet accumulation. Schectman asserts that these developments, including opaque leasing arrangements involving major banks like J.P. Morgan and Bank of America, point to systemic stress. He warns that once the illusion of abundance breaks, silver could undergo rapid and significant repricing, leaving retail participants to chase momentum long after the strategic accumulation phase has ended.
It's the complete opposite in the equity market, which is actually, I think, stronger, makes a stronger statement. In the equity market, you have massive insider selling, and the big money, the insiders over the last 4 weeks, the institutional have sold 4.2 billion last week. Over the last 4 weeks, 2 billion per week, as the insiders are as the retail mom and pop are at the largest amount of stock exposure ever in history. They're all in on stocks. That says something, I think, about where the direction of the stock market may be going. The insiders know the scoop. Well, look at the same thing in reverse with the metals market, the biggest money in the world. The central banks, the sovereign wealth funds, the family offices, they are draining the world's exchanges, as you know, standing for delivery. The largest delivery in the history of the COMEX market, I believe, in both gold and silver, occurred in May. You can correct me if I'm wrong on that, but I'm pretty sure it did. About $8.5 billion worth of gold was delivered in May, about 4.5 in March. The biggest money in the world is accumulating gold and standing for delivery. And the odd thing about it, to your point, is that the retail investor is immersed in the risk on trade, immersed in traditional, equities and the traditional form of investing. And you have to wonder, if the insiders are massively selling as the on equities as the retail investors are buying, but it's the opposite in gold and silver. Who's going to be right? And my guess is those closest to the information are right, and that to me is very telling. But yeah, you're right. The people on this side of the table in precious metals are missing out what's happening, and that's why we see the lowest premiums we've seen really in a very long time on metals. They're just it's a lack of demand on the retail side more than anything, which is very, very confusing and hard to understand when you see what's happening up there. I'd be curious to your take on the post that Chris Marcus put out last week. And I've always admired Chris's ability to chase down the story from an investigative journalistic standpoint. He's one of the best in this space. And he was talking about the fact that when you have large short positions on COMEX, that they're supposed to typically be offset with long positions in London. And he was framing it with the respect that if indeed the massive short position, the second largest ever in the history of the COMEX by the commercial banks that we see right now, if indeed it really is offset in London, where we're told they have somewhere in the neighborhood of a 250 million ounce float. If they're offset, he was saying that that means there's only 7 million ounces in London that is not encumbered, something to that extent. And if it's not offset, if it's not hedged in London, that means a bank like Bank of America, typically something like that. According to Ted Butler, when he was alive, he would have said it would be Bank of America. But that means that there are banks or a bank that are wickedly, wickedly exposed to a rise. And maybe that's why we've seen on Wednesday of last week 487 million ounces on paper traded. And on Friday, 356 million ounces. They are trying by trading 800 million ounces over 2 days to keep the price below $37 for sure. No, I really can't because it defies logic. It's as if they are trying to. I mean, you could argue they've been the model of inefficiency for a long time. They're trying to perhaps just get the littlest amount of silver, like your interview, the interview that you did that I think everyone needs to listen to, the 2-part interview or 3-part interview, Jack Sermon, I think his name was, and
Yep.
it's one of the 2 go-to interviews that I would tell anyone who wants to know what's going on to listen to. And in it, when he said, I was told by my superiors to only produce just enough silver eagles to not create a backlash, what am I trying to say? A media backlash or something that we're going to have to try and quell. Well, that's obviously what they're doing. And because everything else premium wise has reacted far differently than the American Eagles, which have maintained their premium, not high premium, but higher than everything else simply because the demand is or the supply is not meeting demand. And which is weird because there's plenty of product on everything else, but Silver Eagles have really been that one item that has maintained demand, but the supply just isn't where we would expect it to be. I don't know. I guess I take a lot from that interview that you did with Jack, and I never thought I would hear a Mint official say he was told by his superiors, and I don't know who those superiors would be. I doubt it would have been the lady that used to run it, the HR lady. I forget her name,
Citrus
but
Gibson.
yeah, whatever Gibson. But I think it would be more along the lines of the Treasury Secretary who would have given him those instructions. But yeah, there's no question, really. I mean, you look, they haven't even made a platinum eagle yet this year, and you can see that they're very, very inefficient. But it's almost as if maybe they are restocking the American government, perhaps, and using stupid excuses and lack of transparency and the admission by Jack that yeah, just make as little as possible without creating a backlash that they're doing. Maybe they realize along with all these imports and deliveries into the United States that we have allowed this to become a very detrimental situation to the safety of the country, that we are woefully understocked in things like gold and silver, and that's why they're delivering it into the system. Maybe it is the Treasury that is behind all of these big deliveries. And on one hand, we can't make the admission that we're woefully underprepared for the future as it pertains to something as strategic, not just industrial, but strategic as silver, and at the same time let it all go out the back door to the American public. So, I mean, that would be the only thing that would make sense to me, Bix. I can't think of any other reason why they would go to such great lengths to keep silver eagles from the public when it's in the law, the charter of the mint, that they're supposed to produce as many as is demanded by the public, which they clearly haven't for the better part of 5 years.
Silver is nearing a critical turning point where years of suppressed prices and reliance on paper-based markets may give way to a dramatic revaluation. With physical supply tightening and delivery demands rising across major exchanges, the long-standing imbalance between synthetic contracts and actual metal is becoming unsustainable. As demand from the East accelerates and new settlement systems prioritize physical over derivative-based trading, the ability of Western institutions to control prices through short positions and leasing schemes weakens. A sudden rupture in confidence could trigger a sharp repricing event, one that forces silver into a new valuation paradigm driven not by speculation, but by scarcity, geopolitical shifts, and the reassertion of real asset collateral in global finance. If silver breaks free from its artificial constraints, the reaction could be swift, pulling prices toward levels that reflect not only industrial demand, but also its role as an increasingly strategic monetary asset in a shifting global order. Where do you think silver prices will go next? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.